You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Yeah, and so that's why I'm not buying leverage. I'm more interested in quality. And so, like you were saying, what are you looking for in private placements? I've done a lot of private placements, and I almost prefer no warrants. Because that suggests to me that the company's high enough quality that it doesn't have to issue warrants.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers. Today's show is brought to you by Trilogy Metals. If you're looking for a quality copper developer, look no further than Trilogy Metals. You can find more at trilogymetals.com. This is a sponsor and we feature them. And the company has been very successful of recent with a positive feasibility study for their Arctic project. And the government up there in Alaska has issued a positive record of decision for the Ambler Access Road, which will open up all their projects and future successful exploration to profitable mineral extraction. So that was a huge development where we see other Alaskan projects having some contention and difficulty. Trilogy seems to be progressing nicely. The ticker symbol in New York and Toronto on the big board is TMQ. And again, go to trilogymetals.com if you want to learn more. Well, my guest today is editor and analyst of Exploration Insights. The website is explorationinsights.com. Joe Mazumdar joins me again. Joe, thanks for coming on Mining Stock Education. And let's begin by talking about copper. For the last 6 months, copper has been on a tear. It's about $3 and I believe 6 cents as we speak, which is up from something like $2.10. It seems not long ago. Is this the start of the expected copper upcycle? What is your commentary on how copper has been performing?
Thanks for having me, Bill. With respect to copper and a lot of base metals, we obviously saw that big plunge in a lot of industrial metals in the beginning of the year when China had the big plunge in industrial production and shut down a lot of their manufacturing during the first quarter due to the coronavirus pandemic, which initiated there. But everything's picked up since then. And so the demand has come back as China has come back online, and China is obviously the biggest consumer of these metals, and including copper. The issue for me on copper, why I'm a little more sanguine on that metal, is because of the lack of supply of projects that fits into this potential 2025 window of forecast deficits. And so we really need to know what projects exist right now at potentially an advanced stage, PFS or feasibility study stage, because those are the ones that are going to fill this gap, and there's not a lot of them. And interestingly, because of the pandemic and the way the pandemic moved from Asia into the Americas, it's really seriously impacted a lot of South American or Latin American countries, including some of the biggest that produce copper, including Chile and Peru, and Brazil somewhat in terms of copper manufacturing, but Brazil definitely because the whole country. And so a lot of these ones have been impacted not only from a production standpoint, but also from the development standpoint, because, building in this environment of COVID with peak construction and trying, to keep everyone safe in that and to lower, the risk of, catching it, it slowed a lot of development projects as well as productivity, and that's hitting the market. And so that makes me very sanguine about copper, and that's why I would tend to look for copper projects in either exploration, but potentially more so in advanced exploration to feasibility study stage, to look for projects that fit this 2025 window. So that's why I'm keen on copper, as much from the demand side because of battery manufacturing, but also because of the idea that there's just not a lot of copper projects out there.
Joe, I'd like to get your thoughts on nickel. As I was preparing for this interview, I was thinking perhaps Elon Musk is the most influential tweeter on the markets after Donald Trump. And there's this rumor out there that made Reuters that Giga Metals is in talks with Tesla. So the share price is up 50% on Friday just because of this rumor. What are your thoughts about Tesla, the nickel market, and how the nickel equities, are performing, and what's driving it? Is it essentially Tesla that's driving the nickel equities right now?
Well, background on nickel, I was keen on nickel at the beginning of the year and made an investment last year in a ASX listed explorer in Vietnam, of all places. And the idea there was exposure to the nickel market that feeds battery manufacturers. Because as you well know, when the battery manufacturers were beginning to talk about electric vehicles, the form of the battery, the chemistry was almost a 1-to-1-to-1 ratio of nickel, manganese, and cobalt. Now the sort of the standard is now an 8-1-1, where there's 8 times more nickel than manganese and cobalt. And cobalt is being put down with respect to being an input in the battery because of where the majority of cobalt comes from. So I wasn't keen on cobalt, but in terms of exposure to this battery, phenomenon for electric vehicles and especially scooters in Asia, was exposure to copper, exposure also to nickel, and in the intermediate as also palladium. And so I was interested in all three metals, and so hence I took that ASX listed explorer in Vietnam. The important thing for me was to see that it was nickel sulfide, somebody that could produce a concentrate that could become a nickel sulfate that would feed an intermediate product into the battery market. And so to know that it works and would be a good enough quality, I looked for a company that could, sign an agreement downstream with a battery manufacturer or a car company. That way you get a bit of a stamp of approval that this is actually, could work. The mining part of it isn't hard, and generating a nickel concentrate isn't hard. The difficult part is generating, going from the nickel concentrate to the nickel sulfate and beyond. And that's where the battery manufacturers come in. They don't know how to mine. They don't know how to produce a concentrate, but that gap between the concentrate and the nickel sulfate is really where you want that stamp of approval. And so for Tesla to come in, I'm not sure if it's it's a rumor, speculation or whatever, but for Tesla, potentially to say, oh, hey, here's a nickel project that we might be interested in, for an investor to look at that, and if it's true, that they say, oh, well, that means that this project works for them. I don't know what the economics are behind building it, if Tesla wants to give them all the capital, because that's not what a lot of these battery manufacturers are doing. They'll help them build a plant, but they won't help them build the mine. So that provides a stamp of approval, and you've seen it in the lithium market, with Oro Cobre, when Toyota, the car manufacturer, came in and helped them build their project in Northwest Argentina. So that downstream help is something that people are looking for, I believe, with these battery metals like nickel, and more so lithium. But that's not really necessary for copper, because copper is much more fungible than those two other commodities. But nickel is obviously more fungible than lithium. Lithium's a harder one.
Joe, you invest based on fundamentals, and you do a lot of due diligence before you recommend a company in your newsletter. But when it comes to rumors, they're plentiful in the junior resource sector regarding drill results. It's going to be bad, it's going to be good, or a rumor such as Giga is going to get bought out by Tesla. What is your approach when you see a rumor and you see a stock move based on a rumor? Is it just hands off, I'm not going anywhere near that? Or have you ever taken a gamble on one of these rumors?
No, I don't. It's all speculation. If I owned that stock and it was going up 50% on a rumor, I might just sell it and then buy it back after the rumor dies down. The idea, behind, the valuation of these stocks is, does it actually have anything? And the problem with these rumors is that it will inject some liquidity and it will inject some value into the company based on no news flow. And if you take the foot off the accelerator on that rumor and it starts to die down, all that value and liquidity sort of drains, and then you have to wait for it again, unless that company has some underlying value, like it's delivering news flow, it's got a great working capital position, it's hitting on all its catalysts. And if there's that kind of value in it, that's great, that's fantastic. But I mean, we see that not only in speculators, but we see, that with newsletter writers that will talk up a stock, it goes up 50% that day. I would never buy it based on that, and I don't recommend anybody buying it on that. If I don't recommend the stock, but I say that I'm buying the stock, but I tell my subscribers, if it's in a liquid stock, it might run up, so just wait for it, because that impact is ephemeral. It'll go away, and then you could buy it 3 or 4 days from now, because fundamentally I think it's a good company, but don't pay a 20% premium for it. And timing is important when you're buying these things. You want to get it at the lowest valuation, such that the intrinsic value is in there, but none of the upside.
What other commodities are you looking at besides nickel and copper? Any other commodities you're bullish on?
Well, absolutely. I mean, obviously, we're into gold and silver, and copper, as I said. And so I sort of, divided my investment thesis this year between those precious metals, gold, and silver, having a higher beta than gold with respect to negative yielding debt, expanding monetary policies globally. That sort of thing was where I put my investments into gold and silver for even more leverage. And then the idea of a reduction in greenhouse gas emissions, generating more electric vehicles, so this battery manufacturing thesis that I filled with copper and nickel, and in the interim palladium as well. And also, I'm also looking right now at iron ore as well, in terms of potentially this reconstruction of a lot of infrastructure in countries that needs to be rebuilt. So that's also a theme that I'm sort of studying.
Would you look more towards the producers for iron ore exposure, or would you go for the developers?
Well, I mean, I've done that with gold, where the first kick happens on the producing side. And so, I would buy something like a Pan American Silver, which has done really well with respect to not only gold, but the silver exposure, even though they've been hit by, the pandemic with respect to production. That's something I could consider, but right now I would probably be more leaning towards undervalued companies with advanced projects that the market's not seeing.
Recently, we saw Eric Sprott strike again with a $78 million Canadian investment in First Majestic Silver. What's your commentary here? We usually see him put $2 to $20 million in smaller juniors, but to go into a producer on the New York Stock Exchange, that was quite the investment.
Yes. I mean, the thing is that, obviously he likes silver, and potentially the investments he's made in all these little junior silver explorers that are really, their leverage is based on discovery more potentially than silver going, or doubling. It's potentially better to have the, the exposure to a silver producer, such, like Pan American or somebody like that provide even more leverage to the underlying commodity, if that's what you're so keen on. And you can't make that kind of investment in a junior and not own, 100% of it. So, I can see his point with respect to, he's looking for a levered company, silver exposure, liquid, that could basically take an investment of this size and him not having to own the entire company.
We've seen a slurry of financing these last few months. What is your general thoughts on what we've been seeing, and what type of financing has attracted your money in the past few months?
Okay, I mean, if we stick to gold, because a lot of the financings, not exclusively, but many of the financings have been gold and silver. But we also have seen, copper, nickel, as you said, and some other metals and companies exposed to those metals gaining more financings. And what I've seen to date is like to the end of July on the TSX Venture, where half the companies are mining related, that there's basically about 30%, I would say, an uptick in year-to-date numbers in terms of financings. Like in June, July, according to the S&P Global Market Intelligence, we've seen more than $1 billion raised in both months, U.S. The concern would be, as we come into the U.S. presidential elections, which is a big point of uncertainty, is all that uncertainty would be good for gold up to a point. And then any resolution of that uncertainty, or let's say the implementation of a virus for COVID-19, that might have a negative impact on gold. And if we have negative sentiment, when those 4-month hold of all those private placements comes off, do we see a down drop in a lot of these equities that raised money?
So that would be the biggest near-term risk that you would see for resource investors?
Yeah, and so that's why I'm not buying leverage. I'm more interested in quality. And so, like you were saying, what are you looking for in private placements? I've done a lot of private placements, and I almost prefer no warrants. Because that suggests to me that the company's high enough quality that it doesn't have to issue warrants. And also, right now, everybody seems to be getting financed. That's not a distinguishing factor for any company. Like in hard times, because, that person's got money. They got money at, they didn't take much of a discount. They didn't issue warrants. You think, wow, that's a good company because nobody else is getting any money. But right now, everybody's getting money. So it's not a distinguishing feature. So for your, listeners, look at the type of financing, look at the demand, look at, most of these ones tend to be now upsized and oversubscribed, and also trade almost at a premium to the financing because they strategically leave a lot of demand still out there. And so you can almost gauge the quality of the company sometimes by how much of a premium actually it trades at the end of the week when they announce the financing, because that's the amount of demand they left out there. So if they do hit a good catalyst, that's all the demand that's going to be buying on the market, which is what you want more so. So right now I'm still looking at, decent valued private placements where a company is just starting in grassroots exploration, but some of them are drilling old mining districts where, it hasn't been explored for a while. There's new exploration techniques. They're drilling deeper, looking for higher grade and potentially where it was an open pit, looking underground potentially, lower footprint, or some of them that were underground, they're looking potentially open pit because of the higher gold price. But really, when I see one of these private placements, it's got to be people I know that I trust. So I trust them to maintain a decent share structure. There's not a lot of cheap shares that are going to be coming out every 3 months. They're not going to do a lot of financings. They're going to generate catalysts. They're going to put the money in the ground. They're not going to blow out their G&A. It's not a lifestyle company. All that stuff, I don't have to de-risk because I trust the management team to do the right thing. And so management for these junior explorers is really important. And so I will wait for those deals as opposed to just doing deals just to do deals on the fear of missing out sort of philosophy.
So Joe, you would do a post-IPO grassroots early stage explorer with no warrant, you would, because that's part of the enticement, right? At that stage, if you're taking the risk, is the warrant. But for you, you don't need that warrant, just to clarify that.
No, I don't need the warrant because the warrant suggests to me that they need to issue it because the demand wasn't strong enough. When most of the financings I see of companies that make sense don't need to issue a warrant because they don't have to entice them with the warrant, because they could show them the asset, show them the management team, show them the jurisdiction, and that's what says, okay, this is a premium asset. If you want it, I'm not giving you a warrant. And then, well, I want it, so I'm willing not to take the warrant. Other ones that the warrant is the enticement. It's not the asset. So you almost have a semi-disinterested shareholder that's waiting for the four-month hold to finish, sell the share, clip the warrant, and move on. And they don't really care about the asset. It's just like flow through. Why should anybody in Canada, because it's supposedly a tier 1 jurisdiction, why should you have to do flow through? There should be demand for it, hard dollars, which gives you more flexibility in terms of where you spend the money, how you spend the money, the timing and that. And then you don't have a lot of disinterested shareholders, because in 4 months, most of those guys that bought it, who don't really care what the company does, they're just going to sell it for the tax gain, So, when you look at these private placements, you got to really think about, okay, the asset, the people in that, and what is the private placement telling you? For me, I'd buy it in the market as well. After the private placement, because sometimes it trades lower, after they get the money. So if I like the company, I'll wait for it. I'll wait for it, because I picked up things like Liberty Gold and Bellevue Gold, in March when the market tanked. I knew I liked those companies, but I thought they were too expensive. So you sit there, wait, and boom, you can get it. So I wouldn't be running into any of this right now. Like, I own a lot. I've done a lot of buying and selling over the last 12 months, and I believe I got the portfolio in a good place. And so right now I'm reaping the benefits of positive news flow from these companies who are in jurisdictions that under the COVID-19 pandemic they can still work. And that's a key part of the entire thesis.
So, Joe, would you keep, on that note, would you hold on to a junior that didn't have steady news flow due to COVID-19? What would you have to see in a junior for you to hold on to that junior if there wasn't going to be steady catalysts?
Okay, I've got a couple of those that are overexposed to Latin American countries like Peru, Brazil, and Chile. One of them I sold because I didn't see any potential news flow over the next 6 to 12 months, and that dollar that I've got in that company would be better spent somewhere else. So I did sell some. Other ones I haven't sold because I know that they will be drilling soon, or they will be generating some news flow. So that's the other issue, is that, can they generate news flow? Is there potential? What's the valuation? Another one, the valuation that the one I sold, I just didn't see what's going to change, in terms of news flow, so I sold it. The other one I kept because I knew that they were working some of their own assets down there, and they were beginning to gain access in the value. The risk to reward ratio was asymmetric on the downside on that one.
Yeah, that makes sense. And Joe, before you go, last question. Just learned that PDAC 2021 is going virtual. AME Roundup is going virtual. Honestly, I was disappointed, especially about PDAC, because I enjoyed that conference in person. What are your thoughts on how this is going to impact the sector? I mean, deal making, investors finding, meeting with management one-on-one, none of that's going to happen, or it's going to be different, I should say.
Yes, it's going to be very different because, one of the things that we see is that the exploration expenditures by major companies is low. So they're spending almost 4 times more on G&A than they are on exploration. And some of it might be that they're not keen on exploration anymore, that they want to do more M&A potentially, or do more strategic alliances, or invest in juniors or something like that. But problematically, COVID-19 travel restrictions makes their ability to do due diligence, problematic. And so there might be a dam of potential M&A transactions that are sitting behind all these impediments. that we might not see for a while because, their own investor base does not want them to do a transaction without due diligence. We've seen, some minimal due diligence transactions happening by some Chinese state-owned companies. But otherwise, these Western companies, they might have their hands tied with respect to doing any transactions. The SSRM and Alistair, I think they were just approved today, but they did most of their site visits pre-PDAC when they could still actually travel.
Yeah, and I've heard of other third parties being contracted also to do the due diligence for lenders or mining companies.
Yeah, and they have to be in that country. And so that's easy to do in Canada, but potentially problematic if it's the DR Congo,
If you're new to Joe's work, please do head on over to Exploration Insights. He writes an excellent, well-respected newsletter. You can find all the information on his website. Also follow him on Twitter. I'm going to put a link in the show notes. Joe, as always, I appreciate your coming on this show and touching base every few months with your insights. So thank you very much.
Okay, thank you, Bill.